Welcome to Theo Trade. This is Don Kaufman here doing the weekend update on September 10th, 2017. Let's get right to some of the action of the previous week, and then we have quite a bit to discuss in this coming week. First and foremost, we look at expected moves. We talk about them kind of incessantly on the weekend updates here. We talk about them throughout the course of the week, okay? Let's view in the previous week how important this happened to be. So we just got through the shortened holiday week. Again, coming out of Labor Day here, the market rips to the downside on Tuesday, ultimately bounces, and you can see right into the expected move. Throughout the course of the week, we bounced up a little bit, came right back down, just a few points north of the expected move. Again, the expected move, okay, in the SPX was sitting right at 2456, and ultimately the SPX closed on the week at 2461. So again, what these expected moves happen to be, it's options that have traded. It's option pricing that's defining the expected move. But there's hedging activity that's ultimately keeping the S&Ps themselves inside of these expected moves, because if you will, big trading firms are ultimately hedging and fighting, okay, the option premium against the S&P futures. And it's kind of a confusing topic over here, but for the most part, what it means is you have this force that's literally driving markets back inside of the expected move. Now, the opposing can also happen. And what that means is if we were to break substantially outside this expected move, it'll actually force trading firms to sell into it, driving markets down substantially. So anytime, and this is something I really want to drive home to you for this coming week, and you can see I've already got an expected move up here for this next week. I'm going to drive this home to you. We crack outside the expected move. At that point in time, it starts to get serious, okay? Because cracking outside this expected move, at that point, you really hit almost this tipping point, this inflection point, where again, traders can come in and just start punching the button and start to spiral the market downwards, okay? This last week, we kind of get lucky. We bounce back inside the expected move over here. The reason I say this and say, hey, listen, this is a really, in my opinion, a critical kind of juncture we're hitting in this coming week. And now I'm already being forward looking over here. So again, whatever you think about markets right now, the one thing we need to ascertain right off the bat is if you looked at the previous week's expected move versus this week's expected move, okay, this coming week is substantially greater in terms of implied volatility. It's greater than, okay, the week before that. The week before that, well, it's about the same as that. That was actually a week, again, where we saw 30, 40 point expected move. So we have increased volatility. And you should know that, like in any given week, you come in, whether you're trading intraday, whether you're trading, for multiple days, but you should know that we're riding right now on substantially more implied volatility. So as you start to look at the SPX, okay, the volatility for the full 5 days is up to just shy of about 13%. Now, if you're kind of curious, you're like, well, how does that compare, okay, to previous weeks? Well, you can look at previous weeks. There's a tool on Thinkorswim where you can go back in time. I do this all the time. So, here's September 10th, but go back again to, this is a holiday week that we're looking at. But if you go back to the holiday week that ended September 8th, forget for a second about the expected move. All right, because this expected move is only good for what? For 4 days. But the implied volatility for all of last week was sitting at like 7%, which is totally and completely like anemic. You go back the week before that, go back to like the 27th, right? And just look back a little bit. And again, you have to kind of prove the point to yourself. Not to me, but to yourself. You go back the week before that. Oh yeah, look at that. We had a $23 expected move, okay? Markets see headwinds right now. They see risk. Now, let's also go over to the QQQ. What is it? The NASDAQ. Now, we just saw the S&P volatility. Okay, the S&P volatility was 13%. Well, the NASDAQ is closer to 17%. And if you start looking at the Qs, okay, we've got one heck of an expected move coming. All right, look at the previous week versus this week, and you start to behold there's risk out there. Now, you can blame some of the volatility in the Qs, okay, on specifically Apple. Now, let's talk about Apple for a moment, because this coming week, and again, I always mention to people, I'm like, big Apple fan. I'm not necessarily a big fan of the stock, okay? In fact, for disclosure purposes, here, take a look. I'm short 200 shares of the stock. Okay, so for disclosure, I am absolutely short Apple, but I'm a big fan. Why? I got my iPhone, I got my watch on over here, I got my Mac issued underwear. I get it, right? But they have a product launch coming this week. You're like, oh, whatever, it's a product launch. Yes, but this time there's something different. Okay, and unless you have fairly detailed experience, you wouldn't necessarily know this, but the volatility inside of Apple is jacked to 34%. Now, that's a $5.44 expected move. Now, again, if you don't look at Apple often, all right, Don, I get it, volatility's picked up in here. Yes, but how much, okay? And when you start looking at Apple, you're like, whoa, if you're a technician, it's turned the corner, had kind of an ugly day, and has increased supply and volatility. What I want to do to make a quick point is I want to look back at the previous earnings announcement. You're like, why are you looking at an earnings announcement? All right. Again, Apple's announcement is coming on September 12th. It's the announcement, the iPhone, right? Brand new product over here. Maybe they have something spectacular. Maybe they don't. That does not matter to me. Okay. What the product launch is, even if I knew what the product was, I had it in my hand right now, I still wouldn't know how order flow would react. But I want to know what the risk in Apple is versus, like, for instance, an earnings announcement. Because I need to have, like, if you look at earnings announcements inside of Apple, these are big boy moves. There's some pretty wild gaps in here. So look back at an earnings announcement. I'm going to go back to August 1st. When I say look back, I don't mean on a chart. Go look back in time. So we're going to bring up Apple, okay? And we're literally going to go back in time. So I'm going to go back to August 1st. I'm just pulling up right now August 1st data. There it is. So August 1st trading day. And when I have August 1st trading day, let's look at just the weekly options to gauge their volatility. Open up a couple of strikes, have a party over here. Take a look at the previous earnings announcement and the expected move. It's $5.43 on a $150 product. Now, bear with me. $5.43 was the last earnings announcement. Look right now, $5.44. It's ridiculous. It's uncanny. This volatility will go right up to like 47%. What you need to know is this product announcement, and I looked back at all the previous product announcements in recent years. You can do that, all right? Do a little homework over there. For some unknown reason, the volatility in Apple right now is as high as it would be during an earnings announcement. Yet it's not an earnings announcement, it's a product launch. It is a highly unusual state. Now, normally, I wouldn't put this much emphasis on any one underlying. Obviously, though, it's Apple, it's the largest market cap. But the reason for my emphasis in terms of Apple, okay, actually leads us to the XLF, the financials, okay? This past week was a horrific week inside of the financials. Allow me to display this, okay, in other terms. Why am I bringing up the financials and relating it to Apple? Well, for the most part, and I'll come back to the options here in a moment, but for the most part, financials, okay, have been getting ripped apart. This past week, we had literally 3 fairly horrific days. We got a little bit of a bounce on Friday. Heavy volume almost double the norm over there. So when you look at the financials and the sheer magnitude of the financials, you have to recognize the market right now just had a leg kicked out from under it. There's its foot. By the way, that's supposed to be a leg, not a golf club. But there's the foot, and it literally just got kicked out from under it. So when you start to look then at what sector is going to hold the S&Ps together, you have to start to look at products like Apple. Okay? And when Apple has a $5 expected move, you are literally a coin flip away from having a marketplace that could be in a very, very serious situation. Now, let me go back to the XLF because there's an important point to be made over here. The XLF, the next and coming 5 days, we're all the way up to a 23% implied volatility. I mean, if you saw the VIX, think about the VIX for a second. Like, this implied volatility sounds so, like, I guess temperamental, so extraneous to so many people. But when you start looking at like the IV, relate it back to the VIX in your head if that works for you. Like, the VIX is at 12. The volatility in the financials, though, is double that right now. It literally up almost to 24. Okay, so now you've got one of the largest sectors, arguably the largest sector inside of the S&P. Okay, and there's one other really interesting facet over here, and that is we're coming into the September expiration, and there is monumental size to be traded this week. Make no two ways about this. Okay, there's going to be a battle in markets this week. I'm telling you, we are coming into an extraordinarily pivotal week in the marketplace. Okay, respect not only the volatility, but the size of the trade. Just because, by the way, there's 400,000 contracts doesn't mean we're going to 23. Okay, because there's 200,000 contracts here. I'm just showing you all this contract size. What it amounts to is heavy activity likely to be in the marketplace. And again, if you're not aware, like the XLF at a 23% implied volatility, go look at the previous week. All right. So, again, we're coming into here we are at September 10th. Go look at the previous week and it'll help you. Like, look back at September 8th expiration. Last week we were only at 11.78 volatility. Again, it's a holiday week. That's neither here nor there. But for the most part, what we're talking about is that risk in the financial sector has legitimately doubled in 1 week. It's a 100% move. Like, if you saw a stock go from 10 to 20, you'd be shocked, in awe. Yeah, well, here's volatility. Here's risk of the marketplace doubling. So again, financials of critical importance. They already have broken down. It's kicked a leg out from under the marketplace. We expect more volatility in the financials. Now we've actually got Apple coming into a crossroads over here because of Apple. This thing isn't going to look good. All right. What's going to hold us together? All right. We've got Facebook just off all-time highs. Google. You want to talk about Google? You're going to be looking at the 920 level. Ooh, we're just a stone's throw off that. Again, we're coming to this juncture where there's so many different products right on these thresholds. Okay. Last but not least, volatility and volatility futures. People, they're elevated. They've remained elevated. So now we have what? Okay. Financials with a leg kicked out. We've ultimately got Apple with a huge announcement. Okay. We've got volatility increased. Last but not least, taking a look at the bonds. Okay. The bonds have exploded to the upside over here. Wait, there's more. Okay. We're not even going to look at oil, but if you're into the dollar, it's been getting decimated kind of day in and day out. We really do have, again, just, and for lack of a better, analogy, it's a storm, literally, of products that are all displaying risk. And that's ultimately why we feel this coming week could do just that. In addition to it, we do have to deal, okay, with announcements throughout the week too. Okay, the jolts, that's actually what they call the take this job and shove it. But that's also what the Fed looks at a substantial about. There's note auctions. It just goes on and on and on throughout the course of this week, okay, in terms of different junctures of risk over there. So be aware, again, we're coming into a week with a much heavier expected move. Apple, it's almost like it has an earnings announcement. Financials have been under serious pressure. Likely that this was just a bounce over here. Okay. And I also want to keep in mind, as we go back to the SPX and we start the week at 2460. Okay. If we do breach, okay, this expected move, and I am looking to the downside, right? If we breach the expected move to the downside, that's where things can really hit, again, a very critical juncture in markets. Thanks, everybody, for joining us here at TheoTrade on the Weekend Update. Have a wonderful weekend. Bye-bye.